Look, I know the title of this video sounds crazy. How to legally pay $0 in taxes. And a lot of you are probably thinking, yeah right, this is going to be some sort of clickbait nonsense or some illegal offshore scheme. But here's the thing, I'm about to show you something that is 100% legal, IRS approved, and it's used very regularly by high-income earners to dramatically reduce, or in some cases completely eliminate their taxes. It's called a real estate professional status, or REPS for short. Now, for context, I'm Ryan Carrier. I'm a CPA who specializes in real estate tax strategies, helping high-income earners reduce their taxes as much as possible. In my career, I've worked with over 250 clients who are using these exact strategies, like real estate professional status, to reduce their tax bill. And I can tell you that real estate professional status is one of the most beneficial but underutilized tax strategies that's out there. But it's also the most misunderstood and underutilized strategies that are out there. The purpose of this video is for me to walk you through real estate professional status, how it works, the specific IRS requirements you need to meet, and how high-income earners can use this to reduce or completely eliminate their W-2 income or business profits. If you're making over $300,000 or more in a year and you're tired of writing massive checks to the IRS every year, pay close attention to this video because we're going to go deep into this. Alright, so let me start by explaining what real estate professional status is and why it's beneficial. Now, normally if you own rental real estate, any losses you generate from that property are going to be considered passive thanks to the Tax Reform Act of 1986. As part of this, the IRS has this rule to say that you cannot use passive losses, aka from these rental real estate losses, to offset your W-2 or business profits, which are going to be considered non-passive or active income. So even if you're losing money on paper thanks to things like depreciation, you cannot use those losses that are going to be passive to offset your W-2 or business profit. Basically, those losses from the rental properties just sit there being suspended. They're suspended passive losses. And one day you can use them to offset passive income or use them once you sell that rental property. But here's where real estate professional status changes everything about this. If you qualify and meet all the requirements and document it appropriately, you can meet real estate professional status and then use those losses to offset your W-2 or business profits. That's what changes everything. And in short, they become non-passive losses. And that is the game changer. So where do these losses come from? Because hopefully you're not actually losing money from this investment. Well, first you have the normal operating expenses. You have things like property taxes, insurance, interest, utilities, things like that. But then you also have this phantom expense, or a non-cash expense, aka depreciation. And so thanks to a positive net operating income, you're actually going to show a potential loss thanks to the paper loss of things like depreciation. I have other videos where we can walk through an example of how to use things like cost segregation studies to accelerate depreciation in order to maximize that deduction or that phantom loss to get as much loss as possible. But let's just say for this video that you are making $500,000 a year from your W-2 salary. Now, to be true to the title, you're then going to generate a $500,000 loss from your rental properties, and that's probably going to be thanks to, again, cost segregation studies. And to be fair, if you have an acquisition that is going to be all in 1 year, in order to generate a $500,000 loss, you probably are going to have to buy a $2.5 million acquisition. Now, for most people, that's going to be very difficult to do. But one way you can do this is continue to accumulate properties over several years, and then in a given year, say now in 2026 here, you decide to do a cost segregation study and generate a massive loss in the year that you meet real estate professional status, and that generates $500,000 of losses to, again, offset your W-2 salary. Now, if you don't meet real estate professional status, those losses, that $500,000 of losses that we generate, are going to be considered passive and be suspended. But with real estate professional status, we can use that $500,000 loss to offset our $500,000 W-2 income. And after running some quick math on this, that is over $100,000 in federal tax savings, not considering any sort of state or anything else. Now look, before I get into the specific IRS requirements, I want to make something clear. What I'm covering here is just the framework. Actually implementing real estate professional status requires a lot. You need a good plan, you need a detailed time log, and you need to be sure that this actually works for your situation. And that's exactly what we help clients with at Carrier Tax Consulting. We work with high-income earners who want to use real estate tax strategies like real estate professional status to legally reduce their tax liability and make sure everything is structured appropriately from day one. If you're making over $300,000 a year and you're interested in exploring this, there's a link in the description to book a call. All right, let's get into the requirements. So here's the thing. You can't just say, I'm a real estate professional and not actually meet the requirements. The IRS has some very specific requirements that you need to meet, and they're pretty strict on enforcing them, at least according to previous court cases I've reviewed. And this is where people either don't qualify at all, or they think they qualify and they're not tracking their time appropriately, and therefore they end up in trouble if they were to ever get audited by the IRS. So let me actually walk you through what the IRS is going to require for you to be very confident that if you meet this, you have the right documentation in place to reduce that risk as much as possible under an audit. So there are two primary tests that you have to pass to meet kind of the first criteria. Part one is that you must spend 750 hours in a real property, trade, or business. And then part two is that you have to have more than 50% of your working time also in a real property, trade, or business. Now, before I move on, a couple things. Number one, note that this is a specific percentage that they want you to meet and a specific number minimum of hours that you need to get in a given year. Just as a framework for as you think about this, they're trying to make this difficult. This is not something that they thought that everyone would be able to meet, and therefore they put these specific requirements in. So what counts as a real property, trade, or business? Ultimately, there's 11. You have development, redevelopment, construction, reconstruction, conversion, acquisition, leasing, brokerage, rental, operations, and management. Although that might sound simple, and you may be in a work that you might think that sounds like what you do. For example, you might be a mortgage lender and think, oh, I'm in the acquisition process. But in reality, that is not going to be a real property, trade, or business. They're very specific, and we have other court cases to point to how they are very specific in what they're talking about. So I will just caution you to be very careful if you're in a tangential real estate industry. Just be careful and make sure you run your industry by a true tax professional who specializes in this. Now, let's talk about the 50% rule. If you work a full-time W-2 job, and let's assume that on average you're going to work about 2,000 hours a year. If you were going to try to pass the 50% test, you would need to work more than 2,000 hours in a real property, trade, or business. Now, although that has happened in the past, where you can be a full-time W-2 and still meet that requirement, it is extremely rare, and I just would not recommend it to those who are in a full-time W-2 job. And that's why people who meet this 50% test either are business owners or those who are self-employed and have very flexible schedules, or they're part-time in some other employment, or they have a spouse who maybe is not working. But even if you pass the 750 hours and you have more than 50% of your time in a real property, trade, or business, you still have to materially participate in your long-term rental properties. That would be things like being involved in the repairs or improvements or maintenance of the property. That would also include things like management, like making management decisions, communicating with your tenants, collecting rent, and things like that. It won't include things like education hours, like reading a book or listening to a podcast or watching this YouTube video on real estate tax. It's also not going to include things like investor hours, like reviewing financial statements, or research time, like doing due diligence or shopping around. And generally, travel time is not going to count, just to be safe for the sake of this video. But other than accumulating the specific quality type of hours that are going to be considered material participation, now you need to consider what material participation test am I going to meet. What I mean by that is there are 7 examples that the IRS has given us, but you only need to meet one. One common test that I see my clients use who have a spouse who's working full-time in the real estate and looking to meet one of these tests is the 500-hour test. Now, if you only have one large rental property, you don't need to listen to what I'm going to say next. But if you have more than one property, you then need to be considering aggregating your rental properties together. And so what I'm talking about is the aggregation election, which you include on your tax return. What this is going to do is say, hey, I now have several rental properties, and now in order to get the 500-hour test met, I'm going to group the hours across multiple properties. But if you didn't include that election, the IRS would expect that you're going to evaluate every single property individually in order to meet the material participation test. So in short, this is going to make, if you have several rental properties, meeting material participation much easier and allowing you to group more rentals that probably have accumulated losses in combination, allow you to take all the losses from all of your properties instead of having to cherry pick just the specific ones that you do materially participate individually. All right, so now you know what real estate professional status is, what are some of the requirements, but simply knowing the rules and the requirements is very different than actually implementing them correctly with the right documentation. And this is where I see people make the most amount of mistakes. They either don't track their hours correctly, they count activities that don't qualify, or they try to use this strategy when their situation and facts don't support their ability to meet the requirements. So let me show you who this is really meant for and what are some of the biggest pitfalls. Like I said just a couple minutes ago, this is best for those who are business owners, who are self-employed individuals, those who have a more flexible schedule like being part-time, or for those who have a spouse who is currently not working some traditional full-time or even part-time W-2 job and is interested and willing to get involved into the rental properties. Or if you are already involved in real estate, such as your business is being a full-time property manager for others, or if you are a flipper or a wholesaler or a real estate agent, those are good examples of those of you who probably already meet the 750 hours and more than 50% of your time test. But again, it's not going to be good if you are a full-time W-2 employee or you're married as well and both you and your spouse are working full-time and W-2 roles. Now, a couple practicalities with time log, which is extremely important, and if you ever get audited, this is likely where they're going to camp out and evaluate whether you actually meet the requirements. The first thing to mention, you need to have a contemporaneous time log, not something that you make once you're getting audited. Second, using something like a time tracking app can be helpful. You don't have to, but some sort of log or calendar details or a spreadsheet is going to be very, very important. There's multiple ways to keep track. You want to keep track of things like when did you do the work, what did you do, how long did you spend doing it, who was doing the work, and which property were you working on. You can't just say something like, if you're getting audited, oh, I think I spent about 800 hours on my rental properties. That's not going to work. So some common things that are going to disqualify you or mistakes that you're going to make are likely going to be that you include hours that you expected were going to get you to the requirements of the 750 hours or more than half your time or one of the material participation tests, but they don't count and now they take them out of your calculation and now you don't have enough time. Or second, not making the aggregation election to say that you have multiple properties and you need to combine all of them in order to meet material participation, or doing something like you don't meet the 50% of your time test because you think that you only work 1,500 hours a year, or you don't meet the 50% of your time test because you think that you only take 1,000 hours working for your employer, but in reality, they have documentation that says that you're getting paid for 2,000 hours. So which one do you think the IRS is going to believe? Practically speaking, this is going to increase your chances of getting audited. The IRS knows this is a very powerful strategy that can generate massive amounts of non-passive losses, and so therefore they have more scrutiny on this exact strategy. And that's why documentation is so important. If you're in a tax court case, you are not innocent until proven guilty. You are guilty until you prove with correct documentation that you meet said strategy that you're talking about. And if you can't prove it with the right documentation, you're not only going to lose the taxes that you initially saved, you're also now going to have to pay penalties and interest on top of that. Now, some other limitations to this exact strategy. One is that you actually need to have rental properties that produce a loss. And that's usually going to come through things like cost segregation studies and accelerated depreciation, which I've made other videos of in the past, which you can find here. Or if your properties are highly cash flowing and have very limited depreciation, this usually isn't going to be as beneficial to you. And like I'm mentioning, you want to combine real estate professional status generally with things like a cost segregation study and or Form 3115 to take properties that you placed in service in the past and now get the depreciation accelerated to now in the year that you are now using real estate professional status. And you really need to be willing to commit serious time into your business. This is really not meant to be a passive investment, hence the name of making it non-passive. All right, so that is real estate professional status. It's one of the most powerful tax strategies that are out there. but it's also one of the most complex strategies to implement and pull off. If you want to see how real estate professional status and things like cost segregation studies can create massive tax savings for your situation, you can go to watch this video above where I break down how I've helped clients save over $100,000 in taxes using other strategies like this. Thanks for watching. Subscribe if you found this helpful, and I'll see you on the next one.